You need perfect credit to get approved for anything important. We've all heard this one. Your parents probably drilled it into your head, your friends repeat it, and honestly, it sounds completely logical. Why would a bank lend money to someone with imperfect credit, right? So you spend years obsessing over every single point, checking your score daily like it's the stock market, afraid to even apply for anything because you're sitting at 620 instead of that magical 750 everyone talks about. You avoid opening new accounts. You pay down every balance to zero. You basically put your entire financial life on hold. Meanwhile, you're paying rent month after month, watching house prices climb higher and higher, thinking, someday when my credit is perfect, then I'll be ready to buy. But that someday keeps getting pushed further away. But here's what's absolutely shocking. FHA loans approve people with credit scores as low as 580, 580. VA loans, same thing. USDA rural loans, 640. There are literally dozens of loan programs designed for people with less than perfect credit. That means you could have been building equity for years instead of paying rent while waiting for some perfect score that you didn't even need. The perfect credit myth has cost people tens of thousands in missed equity and tax benefits. And here's the kicker. Even with a 580 score, you might pay slightly higher interest, but you're still building equity instead of paying someone else's mortgage. A slightly higher rate beats no equity at all. Renting is just throwing money away. Another absolute classic that makes every renter feel like a complete financial failure. I hear this one all the time. Everyone says you're just paying someone else's mortgage like it's the worst financial sin you could possibly commit. Family gatherings become interrogations. When are you going to stop wasting money on rent and buy a real home? But let's do the actual math, not the emotional math everyone uses. Say rent is $1,500 and a comparable mortgage payment is $2,200. That's $700 difference every month. The smart renter invests that $700 difference in index funds. No property taxes eating $300 monthly, no $5,000 roof repairs, no HOA fees, no maintenance costs, no being stuck in one location. Meanwhile, the homeowner is dealing with a broken water heater, rising property taxes, and a roof that needs replacing. Plus, they're locked into that location even if the neighborhood goes downhill or their job situation changes. After 5 years, the smart renter who invested the difference often has more net worth than the homeowner. The homeowner has some equity, sure, but the renter has a diversified investment portfolio that's been compounding. Plot twist of the century, right? You should always pay off debt before investing. This one sounds so responsible, so mature, so financially disciplined. It's the advice your grandmother would give, and it sounds bulletproof. Let's watch this play out. Both Dave and Sarah have $20,000 in student loans at 4% interest and an extra $500 monthly to work with. Dave follows conventional wisdom. Debt destroyer. Dave throws every extra penny at those loans. He makes massive payments, sacrifices everything, and celebrates when that balance finally hits zero after 3 years. Strategic investor Sarah makes minimum loan payments and invests $400 monthly in index funds, earning 7% annually. She's still paying that debt, but she's also building wealth simultaneously. Fast forward 10 years, Dave is completely debt-free, but has zero investments. Sarah has maybe $3,000 left on her loan, but has $65,000 in investments that are growing at 7% annually. When your debt interest rate is lower than investment returns, you're literally making money by not paying it off early. Sarah made a 3% profit on every dollar she kept invested instead of throwing at low-interest debt. Your emergency fund should sit in a regular savings account. This advice is so boring, it literally puts your money to sleep. And I mean literally. Picture your $10,000 emergency fund sitting in a traditional savings account earning 0.01% interest. That's about $1 per year. $1. Your money is basically in a financial coma. But wait, it gets worse. With inflation at 3%, your $10,000 is actually losing $300 in purchasing power every year while earning $1 in interest. You're going backwards at $299 per year. But high-yield savings accounts and money market accounts are paying 4 to 5% right now. Same FDIC insurance, same accessibility, same safety, just not financially stupid. That same emergency fund could earn $450 to $500 per year instead of $1. It's still completely liquid for emergencies. It's just not brain dead. You can literally move money from high-yield savings to checking in minutes. You need exactly $1 million to retire comfortably. This myth is absolutely everywhere, and it has people thinking retirement is completely impossible before they even start trying. They see that massive, intimidating number and just give up immediately. I'll never save $1 million in my lifetime, so why even bother trying? I'll just work until I die. But here's the real rule that financial planners actually use: the 25x rule. You need 25 times your annual expenses, not some arbitrary $1 million number that someone pulled out of thin air. Let's do the math. If you spend $40,000 per year, yes, you need about $1 million. But if you spend $30,000 per year, you only need $750,000. If you spend $20,000, you need just $500,000. Here's the shocking truth. Your spending habits control your retirement number way more than your income does. The person making $50,000 who spends $30,000 needs less for retirement than the person making $100,000 who spends $80,000. Credit cards are financial poison that will absolutely destroy your life. Your parents probably said this while literally cutting up cards with scissors in front of you. Cash only. Credit cards are the devil. They'll ruin your credit and your life. Cut them up before they destroy everything. Sound familiar? But when used responsibly, credit cards are incredible financial tools. They build your credit history, offer fraud protection, provide purchase protection, and earn substantial rewards. I've personally earned thousands in cash back rewards over the years. The person paying cash gets absolutely nothing. The person using credit cards responsibly gets 2% back on everything, plus builds credit for better loan rates later. If you spend $50,000 annually, that's $1,000 plus in rewards you're missing by using cash, plus worse loan rates because you have no credit history. The cash-only advice is costing you thousands. The stock market is just gambling with extra steps and fancier terminology. People genuinely think it's all pure luck, no skill, and the house always wins in the end. They picture Wall Street like Las Vegas, all flashing lights, desperate gamblers, and rigged games designed to separate you from your money. But here's the historical reality. The S&P 500 has averaged 10% annual returns for over 100 years. Through wars, recessions, depressions, pandemics, everything. That's not gambling, that's documented historical data. At a casino, the house has a mathematical 5% edge against you. In the stock market, history has a 10% edge for you over the long term. These are completely different games with opposite odds. Yes, the stock market is volatile in the short term, but over 10, 20, 30 years, it's remarkably predictable. The gambling myth keeps people out of the greatest wealth-building tool in history. Buy the biggest house you can afford. This advice sounds so smart and ambitious until you realize it turns your dream home into a financial nightmare that devours your entire paycheck. you become what we call house poor, where every single dollar goes to mortgage payments, property taxes, homeowners insurance, maintenance, and repairs. You've got this beautiful house, but absolutely no money to enjoy life. Let's break this down. Your mortgage takes 40% of your income. Property taxes another 8%, insurance 3%, maintenance and repairs 5%. That's 56% of your income just for housing before you've bought a single grocery or paid any other bill. Meanwhile, the person who bought what they actually needed has money left over for investments, travel, experiences, and actually building wealth instead of just building equity in an overpriced house. Your house should be a comfortable place to live, not your entire investment strategy or financial prison. Buy what you need, not what the bank says you can afford. So why do these financial myths persist when the data clearly shows they're wrong? Because they sound responsible. They feel safe. They're what your parents learned and their parents before them. What made sense in 1970 when mortgage rates were 8% and savings accounts paid 5% doesn't make sense when mortgages are 3% and savings pay 0.01%. Add it all up, and these financial myths can easily cost someone $500,000 or more over their lifetime. That's not just money, that's financial freedom, early retirement, and generational wealth. So there you have it. 8 financial facts that are actually expensive lies, costing people hundreds of thousands of dollars. The crazy part? Most people still believe this stuff because it sounds responsible and safe. But now you know better. Your financial future literally depends on your ability to separate financial facts from financial fiction. Don't let these myths cost you your wealth, your freedom, and your future. If this video shattered some financial myths for you and opened your eyes to how much misinformation is out there, hit that subscribe button because I've got plenty more shocking financial truths to share.